We've also got a gentleman here from the Bay Area. What's your name?
Javen.
David.
Javen.
Javid.
Javid.
Javid, I like that. That's different. That's cool.
Thank you.
Good name. Javid. From the Bay Area. What inspired you to come all the way from the Bay Area?
I'm just trying to get into the house flipping.
Cool.
So I decided to start searching up. I was mentioning to Linda that I just started searching up real estate investing conferences or
Okay.
summits, and it popped up. So I'm like, I'm just gonna
Perfect.
go.
You got to see Jeremy when he talked?
Yeah, I was
Perfect. Okay, well, I'm going to try and get some more people in here. We get you going. You don't need the computer. You don't need any of this stuff. Okay?
Here, but not this one.
Let me just get out here and see if there's anybody else.
If you can bring more people in, let's give them 60 seconds.
Wow, I heard you
Okay.
were thin.
You know, you're on. It's getting less and less. And if I even have, do you know who's the guy that used to work with Reggie all the time? And it was his mentor,
Al Lowry?
Al Lowry. Al Lowry came to, do you know Al Lowry? He came to speak at one of my events. He said, Dan, I will come up there if there's only one people. That was his joke. One people. Because Reggie's going to take me to Hearst Castle after I'm through with your meeting, Dan. And so I said, okay, so that's kind of how I'm doing. By the time you're done, there might be one people. If that's okay, I'll do it.
Yeah.
But nobody's going to take you to Hearst Castle.
Yeah, well, you know, if you ask, you get.
Maybe I can convince my wife to take
There
to
you
take
go. You'll love it. Oh, by the way, the road is blocked right now because of the rains. So be sure before you go that you check out how they cleared it up. We like to go up to the winery at Hearst Castle, which is right there on the beach. And we were all ready to go. My wife said, oh, no, I don't think that's going to happen. Not right now.
Yeah.
Okay, so we're going.
Yeah, we're going. So, look, the person who spoke here before Paul, Alex, is in the same profession that I am. We are both mortgage brokers. And so he said very well what I intended to tell you. So I can't really teach you a lot that is new, but I'm going to fill in some of the cracks that he left open because he didn't have that much time.
Perfect.
So we are here because we want to be real estate investors. And people always say invest in real estate investor, but they leave out one very important word. You invest money in real estate.
Right.
Okay? You don't just invest your time, energy, you invest money. And that's what we are in business for. We sell money. So you want to invest and you have a few ways to do it. Let me dispose of the ways in which I can't help you. Okay? You have a lot of money, God bless you, and you use your money to buy the property for cash. That's wonderful, you don't need me. Okay? Number two, you come with a lot of people or you join a group and together you put money in and you buy a 23-unit apartment building and you get part of the rent. God bless you, you don't need me. Now, you want to buy a 1 to 4 unit house, or you want to buy a 5 to 8, or even 9 and more, which is considered commercial. I can help you. You need money. You don't have to use your money. You use other people's money, but you do have to have some skin in the game. So, let's start with buying a property for rental purposes. You heard the word DSCR, debt service coverage ratio, and that's what these loans are called, DSCR. And as Alex mentioned, your cash flow should be even. That is, your mortgage and taxes and insurance should cover, the rent that you collect should cover your mortgage and tax and insurance. That is called, your DSCR is 1.0. If you collect more rent than your mortgage expenses, then your DSCR can be 1.1, 1.25 and more. The reason I'm using these numbers is the higher your DSCR, the lower the interest rate that you pay. Now, your DSCR may be lower. In other words, you are short. You are a little bit in negative territory. You can be down to 80%, and in some lenders even down to 50%. However, you're going to pay higher interest rates. So there are possibilities, depending on how much you are willing and able to pay. Most cases, especially ones outside of California, your DSCR is going to be positive. You're going to collect more money in rent. Now, a very important thing to remember, and Alex said that and I will repeat, when you buy investment property and you don't live there, we don't care how much money you make. We don't look at your income tax returns. We don't look at your 1099. We don't look at your W-9. What we care is the property going to bring in enough money to at least cover 80% of your mortgage? Is your credit score reasonable? And do you have the money for down payment? That's it. Now, down payment for this type of property is usually 20%. If this is a cash out, in other words, you want to buy it, you want to leave some cash, or you want to refinance it, you want to cash out, we are at 75%. But mostly you buy a property, investment property, you got to put down 20%. And the bank will put the rest. Now, also very important part, most lenders require that you own your primary residence when they give you a loan for investment property. The reason is, one of the reasons is, I think, you don't own your primary residence. Your debt-to-income ratio is not all that good. Your income is not all that high. You want to buy a house. You say, okay, I'm buying it for investment purposes. They don't look at your income. You buy the house, and then you go and live there. So that is fraud.
Right.
Okay? And if you do that, you're liable. I'm liable. Your real estate agent is liable. So it's something to be aware of. But nowadays, I have at least 2 lenders. I'm going to take a tangent here because, like Alex, I said, I am a real estate broker, not a direct lender. We have access to about 98 different lenders. So now 2 of the lenders that I usually work with changed their rule, and you can buy investment property even if you do not own your primary residence. You have to show that you have lived there, that you pay rent, and that the place is at least as good as the place that you're buying for investment. Of course, they don't want you to go and move into your investment property. So that makes life easier for a lot of people. You can be a renter and you can still buy investment property. Now, another, I mentioned California, and I said that it is difficult to get a 1.0 DSCR ratio in California because your expenses are high, your mortgage is high, etc. So one case that I'm working on right now, it's a lady who wants to buy a duplex in Ventura. The rent is lower than what her mortgage and tax would be, but at least one of the 2 renters, his lease approaches the termination date a few months from now, and then she'll be able to collect more rent on that property. I can obtain her a bridge loan for 3 years, up to 3 years. She can get the mortgage was 80%. She still has to put down 20%. She has to pay interest only, and she has 3 years of breathing space for that tenant to move out and put in a tenant which will pay a higher rent, at which time she can refinance at normal rate. So she will go from about 10.5%, which is what the bridge loan is, but interest only, she can go down to 7% on a DSCR. Did I explain it right? Okay.
Yeah.
So what's unique in that is that it's a bridge loan for up to 3 years. Because usually you get a bridge loan, our money loan, it's 12 months. But here it's up to 3 years. I say up to because it has no prepayment penalty. So if she's able to collect higher rent in a year and a half, she can pay off the loan in a year and a half. Okay. Meanwhile, she's paying interest on it. There's more to be said about DSCR, but Alex already said it very nicely, so I don't have to give you information that you already heard. Important thing to remember again is they don't look at your personal income. They only look at the income that the property generates. That's it. Now, you buy property on a DSCR if you are in it for the long term. If you want to buy, improve, and sell, you're in it for the short term, then you are looking at a fix and flip. Now, there's fix and flip. By the way, there's also fix and hold, but which generally has the same rules. There are lenders who go by, I'm going to pay you 80% on the value of the property as is, and I'm going to pay 100% of your rehab cost. If your credit score is good and you have experience in rehab, then they will lend you 90% of the as-is cost, and then they will pay for the 100% of the rehab. So you are at exposure only for 10%. There are other lenders who don't separate LTV, loan to value, and rehab. They'll say, I will lend you 80% of the LTC, loan to cost. In other words, the house will cost you that much, the rehab will cost you that much, I'm going to add both numbers together, and I'm going to lend you 80% of that. If you crunch the numbers, you'll see that 80% LTV and 100% of the rehab is a better deal. The bigger your rehab is, the better the deal becomes, because the rehab is at 100%. However, those who lend you based on loan to cost usually have a lower interest rate. So you can crunch the numbers, or better yet, you come to me because I'm a very good number cruncher. So I can then tell you, this is how much money you have to spend, and this is the property, and okay, I think that in your case, we'll do better going loan to cost, or loan to value. And I want to put in a note of caution. Your real estate broker, and also your mortgage broker and your real estate broker is like your lawyer or your doctor. You've got to tell him everything. Don't leave parts that you don't tell him, because it's going to come out. Now, I am still bleeding because I was working on a 3.3 million value as is, 1.63 million rehab. So it's a big one. It's a $4.2 million loan. I have these dollar signs that Paul was talking about in front of my eyes. Okay? And then it turns out that the borrower has an IRS lien. And it doesn't appear on the credit score. I mean, the credit report doesn't show that. But the lenders are thorough and they do a personal investigation. And she has so you got to pay the lien first. Well, I can't pay it right now. Okay, deal done. So if you have any bodies in your closet, please tell your real estate agent agent and tell your mortgage broker, because it's going to come out, and if they know it beforehand, they can find ways of working around it. Okay? Right. So, so much I think for fix and flip. One other caveat. You heard the acronym ARV before, Alex mentioned it, and it's after repair value. So those companies, whether they're going to lend you based on the existing cost plus the 100% on the fix-up, or whether they're going to lend you 80% of the whole thing, they have a requirement that the value of the house, once you've finished improving it, is high enough so that your loan is only 75, in other words, has to be 25% more than what it is right now. If all of your improvement doesn't bring the loan, the value of the house up by at least 25%, then they don't want to get into that. Okay? So it has to be at least 75%, the loan is 75% ARV. Again, we need to crunch numbers, so you do that, and I'll tell you how, or I'll crunch the numbers for you. The last way that I to invest money in real estate that I'm going to talk about is ground-up construction.
Perfect.
So you want to buy land which is either vacant right now, or it has stuff on it that you want to demolish and build something better. We have lenders who would lend you up to 75% of the cost of the land and 100% of the cost of the construction. The important thing is here, you have to have experience. You had to have had partnered in the past, or you partner now with a developer who has done that before. So none of you right now, I think, is a real estate developer, but if you expect to become one, or you want to partner with one, then these are pretty good rates on a ground-up construction. As I said, 75% of the land, 100% of the building cost, and up to 24 months to pay for that. You can always get extension, but extension will cost you money.
What if you're an owner-builder for your own house? A little bit different there than trying to build something else for somebody else?
You want to do a rehab for your own house?
No, ground up.
Oh, ground up for your own house.
And you act as a general contractor.
Okay, I haven't
Owner builder.
had a chance to, an occasion to do that, but I don't see why not.
Okay.
And if this is a real question, not just curiosity, then I will take time and find out for you.
Well, and I'm not asking you to, I'm just wondering if you do, because I did one like 26 years ago with the Montecito Bank and Trust.
Oh, there was that.
Yeah, and they start off saying, yeah, we'll give you the loan on the land. And then when I got ready to build the house, I expected to build it for $300,000, but the contractors all said $400,000, and Montecito Bank and Trust said, well, what do you do now? And I said, well, I act as a general contractor. I sub things out and we get the price where it needs to be. He said, we don't do that. We won't let owner builder. And I said, well, you're kind of in this deal with me already. And I do, I do spreadsheets pretty good, and I've got the numbers right here. And he goes, well, what makes you think you can get it from 400 to 300? And I said, because I have to. He said, well, okay, we'll make an exception. And we moved forward, it all worked out.
Okay, so that's the point. You were in it for only $1 million, you said?
I bought the property when they were asking $350 for $160. It was 7 acres up in the mountains here in Santa Barbara, that long ago.
You were very fortunate at the bank that you had.
Very
good
fortunate,
bank, right?
yeah, and
Because
I,
right now, if it's less than $1 million, the bank owns you. I mean, they make the
right,
rules. If, on the other hand, you owe the bank $10 million, you owe them because they don't want to lose it.
right, right.
So, when you get up to a higher territory, and nowadays in California, it's not difficult to get get up to more than $1 million.
Right.
So you can find, if you find yourself in that situation, I think that you have pretty good way of applying pressure.
Yeah, maybe if you're up north or out of here where it's not so expensive and you get a low enough loan, you could probably do it, right?
Yeah.
Okay.
Another thing about ground-up construction loan is here there is a minimum. And the guys that I work with, in order to give you 75% on the vacant and 100% on the construction cost, you have to borrow at least $2 million. So on a $650,000 job, I got to get you someplace else.
Okay.
And they may give you only 50% on the land and still 100% on the construction.
Okay.
And with DSCR and fix and flip and ground up construction, I told you everything that I know. Now you're just as smart as I am. So if you have any questions, I would answer. If not, you're all welcome to call me.
You work in all states?
Almost no Hawaii. Lenders, I have fewer choices for Nevada, and for DSCR, also my choices are somewhat limited. I mean, I have fewer lenders, so let's shop with in Ohio, because, thank you for reminding me, something that I didn't mention and Alex didn't mention. In a DSCR loan, that is if you buy something and you want to rent it out, in California, and in most states, almost all states, you incur a prepayment penalty. And for some lenders it's 5 years, for some lenders it's 3 years. Now, you can reduce the number of years that you pay penalty by paying a higher interest rate. Usually rule of thumb is 1/8 of 1% for every year that you reduce the prepayment penalty. Okay. Now, coming back to Ohio, by Ohio law there is no prepayment penalty on investment property. So lenders are a little more reluctant to lend in Ohio. So instead of shopping 10 or 11 lenders for your Ohio loan, I can shop only 2 or 3. But it's still possible. The difficult we can do today. The impossible will probably take me a week. That's it.
Thank you very much. Really appreciate that. Okay.